Okay, so hopefully I'm a whole lot less verbose on this video than I was on the last one, because we've already spoken about most of the things that you have to consider when we talk about the cash coverage ratio. All right, so we're going to still be using this same example, all right, to understand what exactly the cash coverage ratio is. I'm going to try and walk you through why we consider it just a little bit more accurate, at least from my perspective, and hopefully you agree. Okay, so we're working together here, and we want to understand, is the cash coverage ratio a more just understanding of our ability to take care of our interest payments, as opposed to our times interest earned ratio, which was the last video. All right, so let's get right into it. This one's pretty cool because we get to introduce a new term as well. Last time we introduced EBIT. Now we get to introduce EBITDA. Okay, so EBITDA. And I actually get to show off the fact that I think I've learned how to actually pronounce this word here, amortization. All right, so depreciation and amortization. On your income statement, that expense will usually be coupled together. And what does that mean? Like, there's no point in actually delineating the difference between our times interest earned ratio and our cash coverage ratio without talking about depreciation and what it actually means. That's just the depreciation and amortization. It's just the loss of value of your assets. All right, so probably because of wear and tear, or maybe if it's an intellectual property, just having it longer makes it less valuable. Whatever the case is, it's just not as valuable, and that's depreciation. But think about it. When things are depreciating, when your car, once you move it off the lot, right, you just paid $10,000 for it, you feel awesome about it. But now it's going 3 miles on the road and you've been driving it, now it's only worth $8,000. Did you actually spend another $2,000? You didn't lose an extra $2,000. No, it just lost value. So you didn't bleed any cash. So the cash coverage ratio is only concerned specifically with the cash that we earn. Okay? If you want to penalize yourself for your assets losing value, that's all well and good, and I'm sure your tax man appreciates it. But if you want to actually thump your chest in front of your banker, well, you're going to be able to get a little bit more cash consideration if you take out depreciation and amortization, because you're not actually losing any physical money. Okay, just one more example so you actually understand why it's important to actually consider EBITDA. Right? We've already spoken about why interest is going to be added back. So earnings before interest, taxes, depreciation, and amortization just means we're going to add back our interest, we're going to add back our taxes, add back the depreciation to our bottom line. Okay, the last example. All right, so our bottom line is our net income. We're going to add those things back. And we already spoke about how we've been panicking using a whole bunch of ratios that basically try to assume the worst, in case we're not able to produce money on a period-to-period basis. But now we're actually saying, okay, we're successful, we're bringing money in, but how many times over can we cover our interest expenses? And cash coverage ratio is saying, let's actually just look at the money we bring in. Let's not penalize ourselves for money we're not actually losing. Okay, so the example I was going to bring up is just taking into consideration rent. Okay, rent is an expense. We take money out of our pocket. We lose money as a company paying our rent. We're not losing money as a company for depreciation expense. Look on our income statement, depreciation gets its own line, and we subtract, in this example, $500 as a result of depreciation, but we didn't actually lose $500 of cash. All right, so we're going to add it back in, and that's all it is. So EBITDA, we're going to be taking our net income, whatever it is. Okay, don't worry about being Sherlock Holmes and following random lines. Just go right to the bottom line, add back in our interest expenses, add back in our taxes. Should I? I don't need to. Taxes. And because I refuse to try and spell depreciation and amortization on camera, we're just going to say add back in our dep/amor. Some love. Add back in some love. Right? So this is how we're going to get our EBITDA. And it's important, again, because it's really a better sign of how much money we made as a company during that period. Okay, so in our example here, we'll reference it really quickly. It says net income here is 45. Oh, that's not in frame now. It is 45 2,000. We'll add back in the $1,000. Okay, so you believe me where I'm getting these numbers from. Interest expense, taxes. So taxes was 1,000, interest was 2,000. Okay, so do I have to actually keep it in order? Yes, let's keep it in order. So let's say first we're adding 2,000, and then we're adding in the 1,000, just so we can be uniform here. All right, and then depreciation, that's the new thing, the key difference from our times interest earned ratio. We're just going to the depreciation line. We understand that we didn't actually lose any cash, so we're going to add it back in because we want to be able to brag to our banker friend that, hey, look, just lend me some money because whatever interest you charge, I can cover it X amount of times with the cash I bring in, the cash coverage ratio, right? So always think we have to show off to our banker friend. Okay, so this is going to be 48,500. All right, this is our EBITDA. I lost a whole lot of smooth points on that one. Okay, so we take our EBITDA and then we look at our interest expense and we go back to that line. Now you can be Sherlock Holmes. We find that it's $2,000, so it's EBITDA 48,500 divided by a lovely $2,000. And the answer, because I've done this ahead of time, is going to be 24.25. So that means if you just think of all the new cash that our company is going to be bringing in, Mr. Banker, lend us some money because we can afford it. We can cover the interest payments 24.25 times over. All right, so we can cover our interest payments walking backwards on the moon, holding our breath, singing a song 24.25 times. All right, so this is cash coverage ratio, and when we compare it to the times interest earned ratio, which do I like better? I actually like the cash coverage ratio, not because it inflates our ego and shows that we can actually cover our interest expenses a little bit more, but because depreciation shouldn't really penalize us, and you can make that argument. You know what? Just don't make the argument. Okay, just let's just differ on opinions if you think times interest earned ratio is more appropriate. But at least if you have an opinion, that means you understand what's going on, and that is the goal. All right, guys, that was it for cash coverage.